And we're live. Tom Lee is waiting to reconnect real quick. I am live from my sister's living room. I have the nice mid-fireplace backdrop. Tom's back. Tom Lee of Fundstrat, ladies and gentlemen, joining us on the Scoop Live. Tom, how are you doing? How's it been? It's been a while since our dinner.
It's been different, right? Working from home. We've been really busy. I think we've been all busy just because now we're at home. We're constantly, basically, at the office. But I guess everyone's been safe and healthy.
No commute. Well, it's funny because last time you were on the Scoop, right, we had a whole slew of issues around Q3, end of Q3 last year. Everybody was concerned about the yield curve inverting, trade tensions and troubles with China. People were worried about the S&P being down 6% if they only knew what was coming now, right? And this is the real deal now. So I guess you made an interesting call that stocks would hit all-time highs in March. And they did, but we didn't know that this was going to happen. Coronavirus and the spread, especially here in the United States, not many people saw it coming. When we got dinner a month ago, or must have been end of February, somewhere around then, you were looking at China and Chinese data and the Chinese markets that as an indicator for where we might go. I guess that's the place I want to sort of start things off with. Instead of crypto, just looking at the S&P, we kind of hit a bottom around March 23rd. Is a V-shape sort of coming to fruition, or do we have lower lows to hit?
Yeah, I mean, that's a great place to start, Frank. I would say we're in unusual times because we're not really facing a business cycle. We're facing a healthcare crisis that has caused capitalism to essentially be put on hold for the moment. We've had essentially a complete shutdown or a large shutdown of the discretionary economy globally. And it's very difficult for markets to understand and try to discount. So I think that's really the backdrop. And so we've seen a huge decline in equity prices globally. But I think, as you pointed out, it's really been sort of a regional crisis when it comes to financial markets, even though it's been a global health crisis. And what I mean by that is, countries that have been dealing with this crisis, from China, South Korea, Japan, Singapore, which have largely contained their outbreaks, and then Italy most recently, which on the 21st of March really seems like the high water mark for their case growth. Those are the regions where the equity markets have found some stability. And so, so the question, I'm sorry, I think I may have lost track of your question, but I think if your question is, where do we stand with the S&P? I think that stocks did do something really important last week. So we had almost a record collapse in stocks. I mean, it almost feels like someone just pulled the plug on equity and we just fell 35%. But that level of selling intensity did register some things that I think would look like, either one of two things. It's either an interim bottom or the low. And we won't know for several weeks whether that's the low or if it's an interim low. But something did happen last week that really marked the lows. And there's several things. I mean, if you guys want to talk about it, I'd be glad to talk about it.
Well, yeah, I'd be interested to know how you're communicating that to your clients and suggesting how they might position themselves when they see what could have been a low, but also, again, we don't really know if there's going to be those lower lows ahead. So what are you communicating with them?
Yeah. So and that's really important. Number one, on Tuesday of last week, we hosted a call with Tom DeMark, who many of those in crypto know well because of the DeMark indicators. But Tom DeMark, we did a call for our clients, we had over 300 people dial into that. And he talked about how his DeMark indicators really triggered what you call a buy countdown, which means that you had, in his terminology, a sequential and a combo count reach what they would call a 13 on the Dow. And the reason that's significant is that in his work, depending on how the index reacts to that level, which happened on Tuesday morning, that could tell us whether markets have actually reached a low. And so the Dow on that Tuesday fell to 18,130 something, which was within points of his what he would see as the downside target. So I think last week the stock market made the bulk of its declines. And another way to measure this, because again, it's really difficult to use fundamental linkages, is Lowry's has a really good measure of buying and selling pressure using a percentage of points that are down for the market and percentage of volume. And we had a total of 90% down days since late February. But last week we had a succession of 3 consecutive days where buying pressure was 80 to 90%. And in the history of Lowry's, which extends 70 years, that has really marked critical turning points for markets. And in fact, a strange coincidence, the last time that happened was March 9th, 09. And then before that, it was March 2003. So those marked important lows. But, you know, to connect that with what's happening in the real world, the only way stocks, so I think investors need to think of it 2 ways. One is some type of important low was established last week. And let's say at the worst case, it's a temporary low, and we could see a revisit of that low sometime in the future. So let's say that that's one scenario. That would be very similar to October 2008. During the financial crisis, and we still had another 5 months before stocks finally bottomed, right? So from October 08 to March 09, you still had 5 months where the market still had 20% further downside. But that October 08 low was important because on that date, roughly 1/5 of the S&P stopped going down. They actually started to go up. In fact, the average gain of that 1/5 of the market was close to 30%. So think about that for a minute. You know, like if this is October 08, even though the index could languish or fall even from here, in October 08 is the day people started to make money picking winners and losers. So I think that's why, whether this is the low or interim low, it's a really important time for people not to just say, I don't want to look at stocks because they're going to go down, or, this crisis is still unfolding, because the mistake they're going to make is, that's huge money. I mean, not only did you make, another 30%, but then, the market bottomed.
So the idea is, you don't want to completely be sitting on cash right now, even if there could be lower lows. There are opportunities hidden, like a diamond in a haystack, mixed metaphor there. But what about some of the other economic indicators that we're seeing? I mean, we saw 3.4 million jobless claims last week. This week, we could see an even higher figure. You have Goldman Sachs predicting 15% unemployment. You have other folks predicting up to 30% unemployment. Some states like Virginia continuing a lockdown until June 1st.
Yep.
The Fed has its money printer, going. Talks of a $2 million stimulus in addition to the one we saw, and not that much response from the markets. Thinking about that backdrop, does that not sort of play into how you're thinking about where this market will go?
Yeah, I mean, those are all important. I mean, the reason it's important is, at some point, we've kind of got 2 concurrent issues unfolding, right? One is the healthcare crisis, which is the spread of this disease. And the second is then the economic cycle that follows that. And the question I think that's going to matter is whether the market is more focused on the healthcare crisis turning or the business cycle turning. And the reason that is important is that if you look back at other market bottoms, stock markets bottom before economic data bottoms, right? So in other words, if you look at the low of the market, it's not the day that unemployment rates peak or jobless claims peak. Markets bottom well before that,
Sure.
because they're already starting to anticipate the turn. So, you know, like when people talk about like how bad the data is going to be, it's going to be ugly. Like, you know, claims could hit 9 million this week, and you know, and makes sense. I mean, we've shut down a big part of the discretionary economy. Mm-hmm. And then when Goldman talks about 30% GDP decline, like let's say that's, you know, the number, you have to remember a 30% number decline for GDP doesn't mean for the full year the economy fell 30%.
Mm-hmm.
They annualize an effect. So a 30% decline in the second quarter is really a 7% contraction of the economy multiplied by 4, because they're annualizing the effect. So, you know, did the economy fall 7% from its peak, or even just from the last quarter? I think that makes sense, right? I mean, there's a lot of stuff that slowed. I mean, you could even say maybe it fell 10%, and that would be a 40% contraction of GDP. But the mistake you'd make is to say, well, the markets have to go down 40% just because the economy did that. I mean, the reason and I know people are doing this, the reason I would caution against it is that you in a normal cycle, you might want to make that connection because the economy is having a cycle because of either demand saturation or returns on capital are declining. But what we're experiencing is like a stoppage of the economy. And so...
Uh-oh.
Is that my...
We lost him.
This is, so it's funny, right? Because this is part of the, you know,
The fun of working from home.
This is the working from home, you know, situation.
Yeah, you know what I think? It's really weird.
It sounds like the Fed's money printer.
Yeah. I don't know what that is. I'm unplugging some things in case it's electronic.
No worries. So I mean, this is so we you know, we were interviewing Alan Lane at Silvergate last Friday, and the same thing happened. My Wi-Fi just went completely kaput. It wasn't live, but it parlays into an interesting topic, which is, you know, we're just doing a live video chat right now, and so technical difficulties with that aren't necessarily meaningful or significant for the market, but for traders and investors who are sort of doomed to be working from home right now, whether it's the kids in the backgrounds or the dogs barking or latency issues, I think that just as a tangent will play into how we think about this crisis years and years from now. But I want to bring in Ryan really quick to sort of segue into what we've been seeing in the Bitcoin markets. It had been fascinating to me that it sort of took a while for crypto to catch up in terms of that March 12, March 13 sell-off. I'll sort of let Ryan take it from here, but in terms of the correlation, right, I've been joking about how it's sort of acting like an S&P 500 future in a sense when you're looking at it right before 6 o'clock. You have talked, you know, not ad nauseum, but very, you've talked about this frequently about how Bitcoin will only see higher highs when the S&P 500 sees higher highs. Let's talk about correlation for a second. Ryan, you want to jump in with a question?
Sure. Yeah. So I kind of want to actually unpack something that Tom said before, if that's okay, before moving on.
Let's do it.
if understand what Tom was saying, we have a market that's still trading on technicals more so than fundamentals. But you point to regional markets, Italy, China, as markets that are starting to maybe trade off of some key metrics, whether that's peak new cases and other various metrics. I wonder if that's what you're saying here is we're going to start seeing the markets stop trading on a technical basis and more look to some of those fundamental metrics.
Yes, I think that, it's clear markets need some visibility. And I think that most people are assuming that visibility is only going to come when the economy bottoms. And that is logical and it's intuitive, but that's not how markets are going to behave. And I think that what they're really going to take their cues from is, when will we start to see the beginning of the end of the healthcare crisis? So I think cases is still the metric that seems to matter the most, because, if you get a case, that leads to hospitalization and therefore risk of mortality. So cases will still be the leading edge of how markets are analyzing the risks. And the epicenter of this is New York. So I think to us, like, New York remains the place where all eyes are on, because number one, 38% of all the cases of COVID in the country are in New York, and close to 40% of the deaths. So if New York City and New York State begin to flatten their curve, I would say you're going to see an instant change in how people shift their thinking. And one will be, again, just like in October 2008, they're going to shift their focus on, even if they think the indices are going to go down, they're going to start picking winners and losers. And I think that the one surprise I think that will come out of this is the resilience of the markets and the economy post this crisis. I think, there's a feeling that the longer we're in this, and it's true, the more broken the economy is. But remember, U.S. it's not punitive capitalism. I mean, U.S. is already reallocating capital now. So I think that the rebound, and we can talk about it, it's going to be very V-shaped.
Well, then let's unpack that, Frank. Just
Sure.
Historically, and some of the research that Fundstrat has put out recently talks just historical precedent of prior V-shaped recoveries.
By the way, you guys, we have like almost a nearly daily newsletter that you guys can just sign up for and receive.
Yeah.
FS Insights. FS Insights.
Yeah, but there's no cost. You actually just have to sign up.
But you talk about some of this in that newsletter, right? The V-shaped recovery of prior cycles. What analogs do you see towards the setup today?
Well, we've written about this for almost 10 years about market symmetry. And in fact, in 2008, during that crisis, there was a feeling that during the financial crisis, you'd have basically an L-shaped financial market recovery, that we were going to collapse and then we wouldn't recover for a long time. But we had written extensively about, when you look at past market cycles, even back to 1871, there's pretty significant symmetry about market moves. So the faster you fall, it is proportionate to the speed of your recovery. I mean, whether it's 1929, the 87 crash, 2011, 2018, the speed of your decline determines how quickly you bounce. And the best rule of thumb is the time required to recover 50% of the losses is 1/2 the time of your total decline. So if it takes 6 weeks to fall, it is almost like clockwork. It'll take 3 weeks to recover half of those declines. And that's one reality. The second is that to recover to new all-time highs takes roughly 2.5 times the speed of the decline. So, let's say roughly triple it. So if it took you 6 weeks to fall, it'll take you 18 weeks to recover. And as crazy as that sounds, I mean, that's essentially how it played out in Hong Kong in 2003 SARS. That's how the Great Recession played out, that it took roughly 2.9 times as long to recover to the highs as it did to fall. So the reality is that it could be different this time. Even in the Great Depression, I think it was 3 times, right? So even after the Great Depression, it only the speed of the recovery was only took us 3 times versus the speed of decline. So there's a lot of symmetry to markets. And I'd say the only exception to that would be if, we have a complete breakdown of capitalism, and so there's no such thing as capitalism. That would be an entirely, that's not maybe out of the realm of possibility. But if it is, of course, that's really bullish for crypto in that world.
What would you say then, before we get to crypto, would be your biggest overstated and understated risk to that happening over the next, say, 6 to 12 months?
You mean of like a complete breakdown of capitalism?
No. To the V-shaped recovery.
Oh, yeah, exactly. Like, can other things enter the fold that can get in the way or impede that recovery? Maybe trade tensions spark up again, or this crisis reveals something deeper about the economy we didn't know.
Yeah. It's, I think number one, it's been surprising how well the economy's functioned, even with a complete shutdown. Like tech is still working fine, internet's working great. People aren't, now incomes have dropped, but the availability of food from the grocery store is still in place. I mean, I would say that if someone had talked about a complete shutdown of the economy, I think that there would be a feeling of like social unrest and disorder taking place, and that hasn't happened. So I think that's kind of a good thing. And I think to an extent that really is going to require a lot of leadership from the White House. And I would give them pretty good marks. I think they've done a really good job of being quite responsive to the crisis, both central banks and the White House. And
from a fiscal standpoint, or just more broadly, even like the health response?
Yeah, I mean, I think I think that there were a lot of stumbles on the health side, but on the fiscal side, I think they get it. That you need to create a sizable war chest to deal with the unanticipated problems, and I think that's why the fiscal stimulus is so large. And eventually, there's going to be another phase that requires actual economic stimulus. And again, in a way, Trump being a closet Democrat is a good thing, because what you have now is Congress and the White House both agreeing to be able to spend a lot of money. And so I think it's going to create future problems because of the amount of deficits, but it's really the kind of fiscal response you want, because you basically want to overprime the economy, right? Once we get back to normal, whether that's from a healthcare cure or from a vaccine, you want all the restaurants to come back, and you want, people to have a reason to sort of re-engage. And so I think that's going to be very positive. And I think that, the risk is, of course, that the disease evolves in a way that's more deadly. Right now, it's looking less deadly, which is good. But, that would just create fear, and this could extend the crisis.
Really quick before we get into crypto, since we're on the topic of fiscal stimulus, how important is this infrastructure proposal that Trump wants to get across the finish line? Does that move the needle on anything?
They've talked about $2 trillion of stimulus, like related to infrastructure, and I think right now it's sort of more of a thought bubble than something that's in the works, partly because they have to execute on what they've already passed. But it makes sense, because what you have to do is start to try to create activity until natural activity recovers. And there's just so many interruptions that are taking place. And so I think it's good, but again, we'd want to sort of make sure we know where we stand in terms of, the healthcare side of this. And I think the reality is if you're tracking the data closely and daily, which what we are, I would say the best thing I can say is that it appears to be linearly growing, not exponential in New York. And I think that's a good thing.
That's interesting. I guess we can go into crypto now. Ryan, take it away.
So I guess with that backdrop, and we know FS Insight, which you should share the link to the newsletter after this so we can get people subscribed. But you guys now have refocused back on a crypto offering, a crypto research offering, and you guys publish on Bitcoin and other assets in the digital asset space. Wondering how that's changed since these events have transpired from a fundamental perspective, when you consider the value prop that's been touted very loudly now for the past couple of years. And more specifically, when you consider it from an institutional perspective and some of the clients that you talk to more broadly in your other research, how has that conversation started to change, if at all?
Yeah. A few things. One is, the use case for Bitcoin has never been greater, right? Because in a time like this where governments are having to really spend money that they don't have by issuing debt or even seniorage, which hasn't happened yet, but and taking advantage of relative strength of currencies and low rates to finance spending, it does create a use case for what I would say is a reserve currency or a store of value that's static and not affected by these moves that are essentially going to create measurable inflation in the economy. And I think we're seeing the response much more on the retail side. We're getting a lot of anecdotes from folks about retail account openings taking place, which is really encouraging. But I think from an institutional perspective, crypto is still not on people's radar screens. And I think a crisis like this might even sort of put it a little further away from their purview. Bitcoin's correlation to equities has actually risen. It's about 40% right now. And I think it's one of the highest correlations we've seen.
Ever. Yeah, this past week.
Yeah, so it's trading, which is something that's been kind of our view, that it's essentially strangely a risk-on asset in the sense that the best years for crypto have taken place when equities are doing well.
Yep.
And the size of the market is still quite small. I mean, for a institutional investor, so not a family office, but I'm talking about someone who's managing institutional money, it's overall a tiny market. Crypto is still only 0.1% of addressable assets. And, besides Bitcoin, the second largest or the largest digital asset is the toilet paper token. So it's not as...
Which I am long, full disclosure, I am
that was a
very
nice
long.
surprise yesterday.
So
how's everyone doing on the toilet paper front? Are we all set?
Yes.
I'm a bidet user.
Really?
I never worry about toilet paper.
Wow.
That's very European of you, Ryan.
Yeah.
Yeah.
That's a scoop. I didn't know that.
Well, I think some Asian countries are big bidet users too. So I'm sure it's, yeah. That's interesting.
I've never used one.
Once you use one, it's hard to go back. Let's just put it that way.
Unsophisticated I am.
Yeah, actually, you know what? As I think about it, I think that the European bidet is very different than the Asian bidets, because like the Asian bidets are those electronic little gadgets, whereas I think it's more analog plumbing in Europe.
Yeah.
I couldn't tell you.
So, Ryan, which one do you have? Is yours analog or digital?
Mine is heated. I don't have one here, but I've been using bidets for a while now, and
Just as we talk
since college. Yeah.
Just as we start talking about bidets, the
buzzing's coming
Bingo.
But
guys, I don't know what that is, because my phone's in airplane mode. I don't know if it's, but I am using my phone.
you sound good to me.
Oh, really? Am I the only one getting it? All right. So bidets, great. They're a great innovation. Let's think about if we're looking at how Bitcoin can prove itself moving forward, what does it need to do for the remainder of this crisis to sort of prove itself to not just the retail folks like me buying up on Cash App, but family offices beyond family offices to sort of sell that message of it being a safe haven? Do we need to see a breakout in the correlation?
Yeah, I mean, a correlation change would be really useful. But I think that in general, if we had to think about the next wave of growth for crypto, I think it still has a lot of growth in Asia and Europe, but the biggest untapped market is still the US. And if it's US retail, Bitcoin adoption among US retail. And the reason I think that matters is we've written about in the past, roughly 1/3 of all the wealth in the world is in the US. That money is not going to be parted with at a time when the US is in crisis or when people have lost jobs, or people think, banks could go under, because all those things then inhibit the ability for funds to flow into crypto. So I think to an extent, Bitcoin not collapsing is actually a good thing, right? Because some people think the price should go to zero. And from a technical perspective, I think a lot of folks thought 5,000 was sort of the downside level, and Bitcoin held that level. So I think that's good. So at least you don't have this dire technical picture. But from the ability for Bitcoin to respond to things like the halving coming up, or to weakening dollar, because the dollar is one of the upshots to this is probably the dollar is weaker in the future. That's all going to be good for crypto, but as long as we have essentially a functioning financial system in the U.S. And again, that would be my expectation, that we don't see the U.S. Financial system collapse, but those are important.
Tom, one of the value props that we see touted from a narrative perspective is this idea that it's maybe a hedge against inflation, similar to gold, how we've seen gold perform as such. What's your response to recent data that shows 10-year inflation expectations pretty much at like 11-year lows? It did bounce off the bottom a couple of weeks ago once the package was finalized, the stimulus package. But how does Bitcoin, and even gold to that matter, because I don't really follow that asset, but how do those expect to perform in a deflationary environment if the inflation doesn't come to fruition?
Yeah. Well, inflation break-evens, and I think that's what you're referring to, right? The
10-year break-even expected inflation.
Yeah. There are actually 3 numbers captured in that number. So the first number is inflation expectations. The second is term premium, which is how much time value you need to pay for. And then the third is really what you'd call the insurance risk, the fear of inflation risk, which gets priced into that as well. And so the collapse of the break-evens, if 2 factors are held constant, then can be attributed all to lower inflation expectations. But it's hard to say how much of that drop is people's change in future inflation versus they don't need to inflation hedge because of what's happening now. And
especially in oil and in just the coma that the market's in right now.
Yeah, and if interest rates all went to zero, then term premium would disappear, and that would cause the break-evens to actually fall as well. So it's hard to say what factors at work. But
interesting.
But is inflation going to pick up? The fiscal package is a very large percentage of GDP.
9%.
Not about 9%, but expectation is there's gonna be more.
Yeah. So, and again, timing's uncertain, but that's a lot of dollars that aren't based on current cash position. We know the supply chains are going to be reworked, which makes things more expensive. And so in some ways, there is the potential for inflation to be spooling. So, but that would be, bullish for crypto.
Interesting.
It's good to hear. Good to hear. I want to be respectful of your time. I know you have a hard stop, but I think to sort of round off the conversation, we've talked about throughout the entire 35 minutes this idea that very soon it'll be time for folks to start looking for those diamond in the rough opportunities. Where do you think they're going to be? I mean, are they going to be in U.S. equities? Are they going to be in emerging markets? What sectors are going to be in play?
Yeah.
What do you observe?
I mean, it's going to fall into really two categories, maybe three. The first category is the winners, right? The companies which got stronger because of this crisis, and in really an unanticipated way. So the usefulness of what they offer has become greater, and then post-crisis, people are actually going to start to use it more. And just an obvious example is like Amazon or whatever. A second category that is going to be the survivors from the carnage. And so if we look at the consumer discretionary sector, which collapsed, and it's down, 80%.
Yeah.
Some things, not everything is going to go to zero, right? Whether it's a quality airline, because people will travel again, or if it's, a company that sells a consumer good that people aren't buying right now, those are going to be big winners, because that's kind of the baby with the bathwater. And the third category is, look, there's just a lot of money being spent on stimulus. And if someone says it just disappears in the economy, that's wrong. I mean, an iPhone's $100 billion cycle, right? 100 billion is what an iPhone is to the global supply chain.
Mm-hmm.
The federal government is about to do 2 trillion, actually, sorry, maybe more like, up to 4 trillion of money. That's 40 iPhones cycles. I mean, it's a lot of money that's going to be doled out. So some companies,
and that's just the U.S. government. You have governments around the world, obviously, right in the same boat.
Yeah, it's a lot of money, and someone's going to win.
Yeah, and we shall see.
Yep.
Well, Tom Lee of Fundstrat, thanks so much for taking out the time from your quarantine. I hope you continue to be safe, and definitely, if you're watching and interested in FS Insights, I think we're going to share the link to that and check it out. Thanks, everyone.
Great.
Thanks, Tom. Thanks,
Thanks,
Ron.
Tom.